Taking distributions from your retirement account is a big deal and should never be left to speculation. You deserve better than that. Welcome back to the Retirement Thinking channel, where today we're talking about taxes. Specifically, there's something just around the corner that will, without doubt, affect your retirement plan. The IRS has changed how much and when you can take money out of your retirement accounts. The often misunderstood rules on required minimum distributions just got an adjustment. Tax-qualified accounts like 401ks, IRAs, and others allow you to build investments while deferring tax. You know that. But eventually, you're required to make withdrawals. Effectively, it's the way the government taps into the tax revenue that has been deferred. They want access to the money that you've been saving for them, really. These rule changes, on the surface, might seem to be a good thing. Maybe. I'll give you my opinion on that later in the video. Here's what's happening, though. The IRS has recognized that people are living longer. So instead of calculating distributions based on a 25.6-year life expectancy, IRS tables will now use a 27.4-year life expectancy. You can see these tables at this website. I'll link it below in the description. Additionally, instead of requiring distributions at age 70 and a half, the new required age is 72 years old. So what does this mean for retirees? Well, here's what the IRS says. The effect of these changes is to reduce required minimum distributions generally, which will allow participants to retain larger amounts in their retirement plans and account for the possibility they may live longer. To accommodate these changes, all the life expectancy tables were changed, including the single life table, the joint and last survivor life table, as well as the mortality rates table. Now, when does this all start? Well, the new rules take effect for distributions beginning January 1st of 2022. Now, on the surface, taking smaller RMDs later in life and leaving your funds invested for a longer time might sound like an improvement. But is it really? Well, I guess if nothing else changes, you could say these new rules are an improvement. But the one thing we know for sure is that things always change when it comes to tax law, and this RMD modification is proof. The situation you have to be most concerned with is if there's a tax increase. Can that happen? Absolutely. Income tax increases are a regular topic of conversation in Washington, and nothing has changed. The reality is we know for sure that they are going to increase because the current tax plan sunsets after 2025. So, whether or not any other tax increase talk manifests itself, the existing plan will bring higher taxes. In this situation, the new RMD rules might not actually be an improvement. See, in a higher tax environment, you'd likely take minimum distributions to avoid paying more in current taxes. But it may very well result in the exact opposite. Under these conditions, it might be better to take more than minimum distributions to help keep from being exposed to higher future tax rates. Based on what we know is going to happen now, there's only a short window of time to take advantage of the current lower tax rates. Remember, your tax-qualified account has the federal government as a partner, and they can change the rules whenever they like. In this case, what might look like an improvement may turn out to be just the opposite. How can you know for sure? Well, by analyzing all of your financial details with a comprehensive financial planning process. You might have expected that answer from me, but it's true. Taking distributions from your retirement account is a big deal and should never be left to speculation. You deserve better than that. Okay, that's what's in my retirement thinking for now. Please let me know how you feel about the RMD changes and what you think is going to happen to taxes in the near future. Thanks for watching.